Most traders make this game way harder than it actually needs to be. They chase complex strategies. They study 50 different setups. They switch systems every other month looking for something that finally clicks. And the whole time, the actual answer has been sitting right in front of them. Embarrassingly simple, almost insultingly straightforward. Today, I am going to give you that answer, and I am going to prove to you, with real trader stories and real psychology, exactly why simple is not just good enough. Simple is the actual edge. In the next 20 minutes, I am going to walk you through 3 specific reasons why simplicity wins in trading and complexity destroys accounts. For each one, I am going to show you a real trader who learned this lesson the expensive way. I will explain the exact psychological trap that keeps traders addicted to complexity, and I will give you the precise, immediately applicable fix. By the end of this video, you are going to understand why the most consistently profitable traders run the simplest systems, and you are going to have a clear path to building that simplicity into your own trading starting today. Let's get into it. Let me tell you about Nathan. Nathan is 30 years old and has been trading for just over 2 years. He is genuinely intelligent. He has a technical background, works in software. He is comfortable with data, systems, and complexity. When he came to trading, he brought all of that with him. Nathan's trading system, if you could call it that, had 14 rules. 14. He had spent 6 months building it. He had back-tested it obsessively. He had a scoring system where each setup got rated out of 10 before he entered. He had filters for session times, volatility conditions, specific price structures, multiple confirmation signals, and a proprietary checklist he had developed himself. He was incredibly proud of it. His results after 2 years? He was down overall, not catastrophically, but consistently, quietly losing, month after month. Small losses. Occasional good weeks that never held. He could not figure out what was wrong. The system tested well, the logic was sound, the rules made sense. But in live trading, it was falling apart. When I sat with Nathan and watched him trade in real time, the problem was immediately clear. He would see a potential setup forming. He would start going through his 14 rules. By rule 6 or 7, the entry window had passed. The setup had played out without him. He either missed it entirely or entered late, at a worse price, with a worse risk to reward, because the complexity of his system could not keep pace with real-time market movement. And on the occasions when he did enter within the entry window, he was second-guessing himself through the entire trade. Did Rule 9 apply here? Was the scoring system accurate in these conditions? Was he missing something his checklist had not accounted for? The cognitive load of managing 14 rules during a live trade was creating constant mental noise. And that noise was expressing itself as early exits, unnecessary stop-loss adjustments, and a general inability to just trust the trade and let it develop. Nathan is not unusual. He is actually representative of a very common type of struggling trader, the over-engineer. Someone who has mistaken complexity for thoroughness. Someone whose intelligence and attention to detail, which serve them brilliantly in most areas of life, have become a specific liability in trading. Here is the question worth sitting with. How many rules does your current trading system have? Not the rules you wrote down, the rules actually running in your head during a live trade. Most traders, if they are honest, will find that number is somewhere between 8 and 20. And every single one of those rules is competing for processing capacity at exactly the moment when clean, fast, confident decision-making is most required. Why it happens psychologically? The addiction to complexity in trading comes from a psychological principle called the effort justification effect. Your brain is wired to believe that things requiring more effort must be more valuable. More work in equals more quality out. This is a reasonable heuristic in most of life. If you study harder, you usually learn more. If you practice more, you usually improve faster. But trading breaks this rule spectacularly. More rules do not mean better decisions. They mean slower, noisier, more cognitively burdened decisions. There is also something called the illusion of control. When you build a complex system with many variables, filters, and conditions, you feel like you are accounting for all possible scenarios. You feel like you have reduced risk through thoroughness. But markets are fundamentally unpredictable in the short term. No amount of complexity reduces that unpredictability. What complexity actually does is create the feeling of control without the reality of it, while simultaneously slowing down your execution speed and increasing your cognitive load. And then there is the sophistication bias. Many traders, especially those who are intelligent and educated, feel subconsciously that a simple system cannot be serious. A simple system sounds amateurish. A complex system sounds professional. This bias keeps traders adding rules, adding filters, adding conditions, not because more rules produce better results, but because more rules feel more legitimate. The complexity is performing sophistication rather than producing profitability. The exact fix, the weird, counterintuitive fix is this: cut your system down to 3 rules. Just 3. One rule that tells you when to enter. One rule that tells you where your stop loss goes. One rule that tells you where your target is. That is a complete trading system. Everything else is noise. Here is how to implement this practically. Write down every rule your current system contains, every condition, every filter, every confirmation you require. Now go through that list and ask yourself about each rule. If I removed this rule, would my entry quality drop significantly? Or would I barely notice? Be honest. Most traders find that 3 to 5 rules genuinely affect their decision quality. The rest are comfort blankets. Rules they added during a losing streak to feel safer. Rules they copied from a course that do not actually fit their trading style. Rules that sound logical but add no real signal value. Keep the 3 to 5 that genuinely matter. Delete the rest. Then trade your simplified system for 30 days without adding anything back. What you will find is that your entries become faster and more confident. Your in-trade management becomes calmer. Your ability to actually follow the system improves sharply, because following 3 rules is achievable under real-time pressure in a way that following 14 never is. Nathan simplified his system to 3 rules. Entry condition, stop placement, target level. That was it. His first month with the simplified system was his first profitable month in over a year. Not because the market changed, because his brain had the processing capacity to actually execute the system correctly for the first time since he built it. Cut your trading system to 3 core rules: entry, stop, target. Complexity is not sophistication. It is friction between you and clean execution. The simpler the system, the more consistently you can follow it. Meet Cassandra. Cassandra has been trading for 20 months. She has a specific problem that she describes as hot and cold. Some weeks she trades brilliantly, calm, precise, profitable. Other weeks she cannot seem to do anything right. Her results across a month are wildly volatile. A great week followed by a terrible one. A strong start to the month followed by giving it all back before the month ends. When Cassandra and I reviewed her data together, one pattern was undeniable. Her worst weeks almost always followed her best weeks. After a strong, profitable week, she would come into the following Monday with elevated confidence. That elevated confidence expressed itself as slightly larger position sizes, slightly earlier entries, slightly lower standards for what constituted a valid setup. She was not consciously making any of these changes, but the data showed them clearly. She called it a hot streak mindset. After winning, she felt like she had the market figured out. Like her read on conditions was especially sharp. Like she deserved to take a little more risk because recent results had earned her that trust. And every single time she went into that mindset, the market corrected her swiftly. The inverse was also true. After a bad week, Cassandra would become excessively cautious. She would miss valid setups because she was hesitant to trust her own judgment. She would enter trades with smaller sizes than her risk rules specified, which, while safer, also meant she was not extracting the full expected value from the setups she did take. Her results in these defensive periods were flat or slightly negative, even when the market was offering genuine opportunities. What Cassandra needed was not a better week. She needed a more consistent week, a week that looked exactly like every other week, regardless of what the previous week had looked like. Same process, same position size, same entry standards, same exit discipline. Week after week after week. Not brilliant, just relentlessly consistent. This is the second simplest truth in trading that most traders cannot actually execute. Consistency is the edge, not finding the perfect trade, not reading the market brilliantly. Executing the same process the same way on every single session. Whether last week was wonderful or terrible, is the behavior that produces compounding results over time. Here is the question worth asking right now. In your last 3 months, have your best weeks made you looser in the following week? Have your worst weeks made you more hesitant? If the answer to either is yes, you are trading with a process that fluctuates based on recent results. And a fluctuating process cannot produce consistent results. The output cannot be more stable than the input. Why it happens psychologically? Cassandra's hot and cold problem comes from a concept called recency bias. Your brain disproportionately weights recent events when predicting future outcomes. After a winning week, recent evidence suggests you are performing well, so your brain projects that performance forward. I have been right a lot lately. I am probably going to be right again. I can afford to be slightly more aggressive. After a losing week, recent evidence suggests the opposite, so your brain becomes cautious and protective. Both responses feel rational. Neither is, because individual week-to-week results in trading are heavily influenced by random variance. A winning week does not necessarily mean your judgment improved. A losing week does not necessarily mean your system broke. Both could be normal statistical fluctuation around an unchanged underlying edge. But your brain cannot feel statistical fluctuation. It can only feel the recent results, and it draws conclusions accordingly. There is also something called performance attribution error. After winning trades, traders tend to attribute success to skill. After losing trades, they attribute failure to bad luck or market conditions. This asymmetric attribution inflates confidence after wins and deflates it after losses, creating exactly the pattern Cassandra was experiencing. Overconfident after good weeks, underconfident after bad ones, the exact fix. The fix is a concept I call the process anchor, and it has two components. The first is a fixed weekly reset ritual. Every Sunday before the new trading week begins, you perform the same 5-minute review. You look at last week's results. You write down one thing you did well that you want to carry forward. You write down one thing you want to improve. And then, critically, you write this sentence: "This week I am starting fresh. Last week's results do not change my process or my position sizing." That sentence is not motivational. It is a deliberate cognitive reset that interrupts recency bias before it can distort Monday's decisions. The second component is fixed position sizing across all conditions. Your risk per trade is 1% of your account, always. Not 1.5% after a good week, not 0.5% after a bad one. 1%, fixed. Non-negotiable. This removes the variable that recency bias most commonly affects. Even if your confidence fluctuates, your exposure does not. Even if last week was your best week ever, your next trade is sized the same as if it were your worst. The consistency of position sizing is the most mechanical, reliable way to anchor your process when your emotions are pulling it in a different direction. Cassandra implemented both components: the Sunday reset ritual and the non-negotiable 1% rule. Her equity curve, which had previously looked like a jagged mountain range, smoothed out within 2 months. Individual weeks were no longer dramatically different from each other. Some were up, some were flat. Occasionally, one was slightly down. But the wild swings, the brilliant week followed by the terrible one, disappeared because the process that produced the week was now identical regardless of what came before it. Consistency in the input finally produced consistency in the output. Build a Sunday reset ritual. Start every week fresh regardless of last week's results. Lock your position sizing at 1%, no exceptions. A consistent process is the only thing that can produce consistent results. Let me tell you about Tyler. Tyler is 26 and has been trading for about 14 months. His problem is different from Nathan's and Cassandra's. He actually has a decent system. Simple enough. His position sizing is reasonable. His entries are generally solid, but month after month his account barely moves. Small wins, small losses, essentially flat performance. He cannot figure out where the leak is. When I went through Tyler's journal with him, the leak was immediately visible. It was not in his entries. It was not in his stop losses. It was in his exits on winning trades. Tyler was consistently exiting winning trades before they reached his planned target. His planned risk to reward on most trades was 1 to 2. That means for every dollar he risked, he was targeting $2 of profit on paper. In practice, his actual achieved risk to reward across 60 trades was 1 to 1.1. He was capturing barely more than half of the profit his setups were capable of producing. And here is the math that this creates. With a 1 to 2 risk to reward, you can win only 40% of your trades and still be profitable. With a 1 to 1.1 risk to reward, you need to win 48% of your trades just to break even. And Tyler's win rate was 47%. He was 1 percentage point below break-even on a system that, if executed correctly, should have been generating consistent profit. The leak was not bad setups. The leak was early exits driven by anxiety about giving back profit. Tyler would enter a trade. It would move in his direction. At around 60 to 70% of his planned target, his mind would start negotiating. This is good. Lock it in. What if it reverses? And he would exit. Sometimes the trade would continue to his original target without him. Sometimes it would reverse, and his early exit would feel validated. But across 60 trades, the cumulative effect of those early exits was devastating. He was leaving hundreds of dollars of legitimate profit on the table every single month. The simplest win condition in trading is this: let your winners run to their planned target. Not most of the time, every time, without exception. This sounds so obvious that it almost does not need to be said. And yet it is one of the most commonly violated rules in retail trading, because the psychological forces against it are powerful and consistent. Is there a trade in your recent history where you exited early and then watched the price continue exactly to where you had originally planned? If yes, what did that feel like? Now multiply that experience across every trade you take in a month. That feeling of watching your profit run away after you exit is not just emotionally uncomfortable. It is a measurable drain on your monthly results that compounds into a very significant number over time. Why it happens psychologically. The early exit problem comes from a concept called the endowment effect, applied to paper profits. The moment a trade moves in your favor, your brain starts treating that unrealized profit as something you already own, something that can be taken away. And the prospect of losing something you already own is far more psychologically painful than the prospect of not gaining something you do not have yet. So when a winning trade is at 65% of its target and starts showing a small retracement, your brain fires a threat response. We are about to lose what we have. The rational mind knows the retracement is normal. The plan says to hold. But the endowment effect is louder than the plan in that moment. And the exit button gets clicked. There is also something called probability neglect in reverse. When traders are in a winning trade, they overestimate the probability that it will reverse. Every small movement against them feels like the beginning of a reversal. Because the potential loss of current paper profit is emotionally amplified, the brain reads ambiguous market signals as threatening signals, creating a sense of urgency to exit that the actual price action does not justify. And there is the comfort of certainty. A locked in profit, even if it is smaller than planned, feels certain. A planned profit that has not yet been reached feels uncertain. And uncertain outcomes, even when statistically favorable, trigger anxiety in the risk averse human brain. The brain chooses the smaller certain outcome over the larger uncertain one. Not because it is mathematically correct, because certainty feels safe. The exact fix. The fix is what I call the target lock protocol, and it has 3 steps that are implemented before you enter the trade, not during it. Step 1. Before entering, write your target level in your journal and on your chart. Not approximately. Exactly. A specific price level at your planned risk to reward distance. This makes the target real and concrete before the trade begins, rather than an abstract plan that becomes easier to abandon once you are in the trade and emotions are activated. Step 2. Set a hard limit order at your target the moment you enter the trade. Do not plan to exit manually. Place the exit order immediately. This removes the temptation to make an in-trade decision about when to exit. The decision was made before you entered. The order executes it automatically. Your anxious mid-trade brain does not get a vote. Step 3. Close the chart after entry. Not forever. For the duration of the trade, stop watching it. Open it once an hour to confirm the trade is still running and nothing structural has changed. Otherwise, leave it. The more you watch a trade, the more your brain processes every small movement as meaningful data requiring a response. Most of that processing is noise, and responding to noise is how early exits happen. Tyler implemented the target lock protocol. He placed exit orders immediately after entry on every trade for a full month. His achieved risk to reward that month was 1.9 to 1. Almost exactly what his plan specified. Not because the market changed, because he removed his anxious mid-trade self from the exit decision entirely. His win rate stayed at 47%, but his results flipped from slightly negative to meaningfully positive, purely from letting his winners actually reach their planned targets. The simplest win condition is honoring your plan from start to finish. Entry to exit, without modification driven by in-trade emotion. That requires removing the opportunity for in-trade emotional decisions, which is exactly what the target lock protocol does. Use the target lock protocol on every trade. Write the target before entry. Place a hard exit order immediately. Close the chart. Let the plan execute without interference. Your in-trade anxious brain is not your friend. Remove it from the exit decision entirely. 3 simple truths. 3 simple fixes. All of them available to you starting in your very next session. Simple truth 1. Complexity is the enemy of execution. If your system has more than 3 to 5 core rules, it is slowing you down and creating cognitive noise during the moment that requires the clearest thinking. Cut it down. 3 rules. Entry, stop, target. Execute consistently. Nathan's first profitable month in 2 years came from 3 rules, not 14. Truth 2. Consistency is the actual edge. Hot weeks and cold weeks are both dangerous if they change your process. A good week should not make you looser. A bad week should not make you more cautious. Same position size, same entry standards, same process. Every single week regardless of what came before. The Sunday reset ritual and the fixed 1% rule are what make this mechanically achievable rather than just aspirational. Cassandra's equity curve smoothed out the moment her process stopped fluctuating with her recent results. Simple truth 3. The simplest win condition is letting winners run to their plan. Not most of the time, every time. The target lock protocol removes the temptation to exit early by placing a hard exit order immediately after entry and closing the chart. Your anxious mid-trade brain gets no vote. The plan executes automatically. Tyler's results went from slightly negative to meaningfully positive without changing a single thing about his entries, just by consistently honoring his exits. Simplicity is not a compromise. It is not a beginner approach you graduate from when you get good enough. Simplicity is the destination. The most consistently profitable traders in the world run the simplest systems, because simple systems are the only ones that human beings can follow consistently under real-time pressure with real money on the line. Complex systems perform brilliantly in calm reflection. Simple ones perform in the chaos of a live session. And that is the only performance that actually matters. If this video gave you something genuinely useful, subscribe right now and hit the bell. Every single week I put out content at exactly this level. No hype, no income screenshots, no beginner advice dressed up in a flashy title. Just the honest, practical psychology and discipline work that builds real trading consistency over time. And in the next video, I am giving you the complete daily routine of a consistently profitable trader. Morning to close, every habit, every preparation ritual, every post-session practice, the full infrastructure behind everything we have talked about in this series. That video is the blueprint. Subscribe and do not miss it. See you there.